You will need to pay capital gains tax, CGT, on a buy-to-let property in the UK when you sell it if the property has increased in value since you purchased it. Buy-to-let properties are considered investment properties, and unlike your main residence, they do not qualify for private residence relief. However, a property that was your main residence prior to being rented out would qualify for some private residence relief. Here's an overview of how CGT works for buy-to-let properties. Private residence relief, PRR. If the property was your main residence at any point, you may be eligible for private residence relief, which exempts you from CGT for the period during which the property was your primary home. Full exemption, you won't pay CGT on the part of the gain that corresponds to the time you lived in the property as your main home. Final period exemption, you are also exempt from paying CGT for the last 9 months of ownership, even if you were not living in the property during that time, for example, if you were renting it out. Previously, this exemption was for 18 months, but it was reduced in April 2020. CGT rates on buy-to-let properties. The CGT rates for residential properties, including buy-to-let properties, are higher than for other types of assets. The rates are 18% for basic rate taxpayers, 28% for higher or additional rate taxpayers. The rate you pay depends on your total taxable income and the size of the gain. The gain is added to your income for the tax year, and if this pushes you into the higher tax bracket, you may pay the 28% rate on some or all of the gain. Calculating the gain. To calculate your CGT liability, you need to determine your capital gain, which is the difference between the sale price of the property and the price you paid for it. You can also deduct certain allowable costs, which include purchase costs, the original price you paid for the property, plus associated costs such as stamp duty, legal fees, and surveys. Selling costs, costs incurred during the sale, such as estate agent fees and solicitor fees. Capital improvements, significant improvements you made to the property, such as adding an extension or a new kitchen, but not regular repairs or maintenance. After these deductions, the remaining gain is your taxable amount. Apportioning the gain. When you sell the property, the gain is usually apportioned based on the period you lived in the property versus the period it was rented out. Here's how the gain is typically split. Exempt period. The time when the property was your main residence, including the final 9 months, is exempt from CGT. Taxable period. The gain attributed to the rental period after subtracting PRR will be subject to CGT. Annual CGT allowance. You can also deduct the annual CGT allowance, which is a tax-free amount that reduces your taxable gain. For the tax year 2023 to 24, the allowance is £6,000. This means you only pay CGT on the portion of your gain that exceeds the allowance. The CGT allowance will decrease to £3,000 in the tax year 2024 to 25. Example, let's say you bought a buy-to-let property for £200,000, spent £5,000 on stamp duty and legal fees, and then sold it for £300,000. During ownership, you made capital improvements worth £10,000, for example, an extension. Total gain, £300,000, sale price, minus £200,000, purchase price equals £100,000. Allowable deductions, £5,000, purchase costs, plus £10,000, capital improvements equals £15,000. Taxable gain, £100,000 minus £15,000 equals £85,000. Annual CGT allowance, 2023 to 24, £6,000. Gain after allowance, £85,000 minus £6,000 equals £79,000. If you're a basic rate taxpayer and your income stays within the basic rate band even after adding the capital gain, you'll pay 18% on the taxable gain. If your income pushes you into the higher rate, part or all of the gain will be taxed at 28%. Reporting and paying CGT. You are required to report and pay CGT on the sale of a buy-to-let property within 60 days of completing the sale. This can be done through the UK government's online capital gains tax on UK property service, and you will also need to declare the gain in your self-assessment tax return. Conclusion. You will need to pay CGT on the sale of a buy-to-let property. The amount of CGT depends on the gain you make, your income tax bracket, and any deductions or allowances you are eligible for. Make sure to account for purchase and sale costs, as well as the annual CGT allowance, to reduce your tax liability. Consulting a tax professional or accountant can help ensure you handle the tax obligations correctly.